We've just talked about the economic incidence of a tax, and we're now going to turn to the mirror image of a tax, which we call a subsidy. Taxes are money flows into the government, whereas subsidies are money flows out of the government. And just as with taxes, there are different possible statutory incidences of a subsidy, different ways of providing that subsidy to different people in the market. Think about the gasoline market, for example, and suppose that we wanted to subsidize gasoline. We could do it through consumers and say consumers are going to receive $1 per gallon back for every gallon of gasoline that they buy. Or we could do it by providing payments to firms and tell firms that they're going to receive $1 per gallon for every gallon of gasoline that they sell. Two different statutory incidences of a subsidy. Of course, with taxes, we just found that the economic incidence, the economic effects of the tax didn't depend on the statutory incidence. And we're going to find the same thing for subsidies. But let's go through the reasoning again to solidify how we think about tax or subsidy incidence. So let's think first about consumers receiving the subsidy. We again start with a picture of the equilibrium in the gasoline market before there are any taxes or subsidies. And we ask which curve is going to shift. Well, the subsidy is being given to consumers, so the curve that comes from firms is unaffected. The supply curve doesn't change. Instead, the demand curve must be shifting. So we can take a point on the demand curve and say, suppose you're the consumer who was willing to pay that price for the last gallon of gasoline that you consumed. Will that still be the maximum price you're willing to pay for that last gallon of gasoline once you know you're going to receive a subsidy? And of course the answer is no. If you know you're going to get $1 back, you'd be willing to pay up to $1 more for that gallon of gasoline. Because once you get that $1 back, you'll be back to the original price you were willing to pay. So if we take a point on the demand curve, we know that point is going to shift up by exactly $1. And that's going to happen for every point on the demand curve. So the entire demand curve is going to shift up, leading to a new equilibrium with a higher equilibrium price and a higher equilibrium quantity. Let's call that higher price P prime. Is that price $1 higher than the original price? We can tell in the graph that it's not, because this difference between these two curves is exactly $1. And if that difference is $1, then the part that's above the equilibrium price, the original equilibrium price, is less than $1. So demand shifts, causing the equilibrium price to rise, but by less than $1. What about if that subsidy is given to firms? Well, now the firms' curves change. Consumers are unaffected by this subsidy, so their demand curve remains the same. But the government has in essence lowered the marginal costs of bringing gasoline to market. The firms still have to pay all of their marginal costs, but now they're going to get $1 back from the government for every gallon. So in effect, their marginal costs have shifted down by $1. And since the firm's supply curves are made up of portions of the marginal cost curves, that means the supply curves for the firms are going to shift down by $1. And if that happens for every individual supply curve for each of the firms, then when we add up those supply curves to come up with the market supply curve, we know that that market supply curve is going to shift down by $1. That's going to lead to a new equilibrium with a lower equilibrium price and a higher equilibrium quantity. Let's call that new equilibrium price P double prime. And we can again see that the drop in price is not the full $1 of the subsidy, because we can see the subsidy right here. The difference between these two curves is exactly $1. And if that difference is $1, then the portion that lies below the original equilibrium price is less than $1. So now we have a rightward or downward shift of the supply curve, leading to a lower equilibrium price, but lower by less than $1. And again, just as in the case of taxes, when we look at these pictures, it looks like the two different ways of giving the subsidies have different impacts on the gasoline market. But then once again we can look underneath. So we have these lower graphs where we're going to unclutter what happens in the upper graphs and take just what we need from those graphs. If we look at this upper graph, we see a wedge that's fit to the right of the equilibrium, where the size of that wedge is exactly $1 and the upper end of the wedge is the new equilibrium price. So we can take that wedge and bring it down to the lower picture. And we know that the upper end of that is that price P prime. And of course, the quantity is going to be higher than the original quantity. But what is that P prime price? That's the price that consumers are paying to the firms. But is that really the price that consumers are ultimately paying? No, they're getting $1 back for every gallon that they bought. So the price that they're actually paying is $1 lower. And this distance is exactly $1. So the lower end of this wedge gives us the price that consumers pay once they take into account the $1 they get back from the government. But the price that the firms receive is this higher price. That's the price consumers originally pay the firms. The firms get to keep that, but the consumers get $1 back for every gallon they bought. What about the case where we give the subsidy to the firms? Well, now we have a wedge again to the right of the original equilibrium. We can bring that wedge down, and we see that the lower end of that wedge is the price we have in the upper picture, P double prime. But what is that price? That's the price that consumers are paying to the firms in the market. But is it the price that firms actually get to keep? They certainly get to keep that price, but they also get $1 back. So when they get $1 back, they get $1 more than what consumers paid them. So this is what consumers pay, but the firms actually receive $1 more than that because of the subsidy. And of course, the quantity in the market increases at the level where we fit that wedge to the right of the original equilibrium. Well, now we have two graphs that look identical. In both cases, whether we gave the subsidy to consumers or to the firms, we end up with consumers paying a lower price and firms receiving a higher price. We end up with a wedge to the right of the original equilibrium that determines where the new equilibrium quantity is going to lie. And since that wedge is the same size in both pictures, that increase in the equilibrium quantity is going to be exactly the same. So once again we find that the economic incidence of a subsidy in this case does not depend on the statutory incidence of the subsidy. The economic effects of the subsidy are the same, regardless of whether you pay the subsidy to consumers or to firms.